We are now entering the final countdown. It is January 2nd, 2026, and we are exactly 48 hours into the most significant supply shock in the history of the silver market. At precisely midnight on January 1st, China activated its export licensing system for refined silver. And ladies and gentlemen, I want you to understand that what happened in those first 2 days is not a policy adjustment. This is not a trade negotiation tactic. This is the weaponization of the most strategically vital industrial metal on Earth, and the fracturing of global pricing has already begun. Silver closed at $72.71 per ounce today, up 145% from where it stood 12 months ago, and that number means absolutely nothing. Because the real price you will pay for physical delivery in the next 6 months will be triple what you see on your screen right now. The split between paper promises and actual metal has become a chasm so wide that COMEX itself became irrelevant overnight, and the institutions that have controlled silver pricing for half a century no longer have the metal to deliver on their contracts. This is not volatility, this is the great silver reckoning, and it begins now. Ladies and gentlemen, this is Capital Key, and we are watching the global silver market disintegrate in real time. Let us establish exactly what happened at midnight on New Year's Day, because most analysts still don't understand the magnitude. China's Ministry of Commerce published its final list of authorized exporters on December 30th. Only 44 companies received licenses to export refined silver during 2026 and 2027. That number sounds reasonable until you realize that China controls 60 to 70% of the world S refined silver production and exported over 4,600 metric tons in just the first 11 months of 2025 alone. Do the math with me. That's 147 million ounces flowing into global markets annually. And now that entire supply stream is controlled by 44 state-approved entities operating under government quotas that have not been disclosed. But here is where it gets truly sinister. Look at what China exported in October 2025, a single month, 660 metric tons. That is 21 million ounces in 30 days, the highest monthly outflow in recorded history, and it happened exactly 2 months before the licensing system activated. China was not selling silver in October. China was executing the largest pre-lockdown drain in commodity market history, pulling every available ounce out of Western vaults before slamming the door shut on January 1st. Now the global silver market exists in 3 separate realities, and none of them reconcile with the others. Reality number 1 is COMEX spot pricing trading at $72.71 as of this morning. Reality number 2 is Shanghai Futures Exchange silver, which closed at 17,074 yuan per kilogram, translating to roughly $76 per ounce when you strip out the currency arbitrage. But reality number 3 is the street, and that market is already gone. Physical silver dealers in Europe are quoting $88 to $92 per ounce for delivery in February, and those are the dealers who still have inventory. Premium spreads have exploded from the normal $3 to $4 range to $18 to $22 over spot in just the last 96 hours. And what you need to understand is that these are not speculative markups. These are the premiums required to actually source metal from the collapsing supply chain. The London Bullion Market Association, the LBMA, went into backwardation in early October and never came out. For those who don't trade futures, backwardation means near-term contracts trade at a premium to future delivery, which signals one thing and one thing only. There is not enough physical metal available now to meet current demand. Annualized backwardation rates hit 20% on October 10th, 2025, when the LBMA market seized for 90 minutes due to lack of liquidity. That was not a technical glitch. That was the moment London ran out of immediately deliverable silver. Let us look at what is happening in the physical vaults, because the inventory collapse is measurable, and it is accelerating beyond any historical comparison. COMEX registered silver inventories, the metal that is actually available for delivery against futures contracts, have been demolished. In December 2025 alone, over 47.6 million ounces were withdrawn from COMEX registered vaults. That represents more than 60% of the entire deliverable supply drained in a single month. As of this morning, total COMEX registered silver sits at approximately 28 million ounces. And with January delivery obligations still outstanding, that number could drop below 15 million ounces by the end of this month. I want you to understand how impossible this is. The COMEX silver market trades 180 million ounces of paper contracts daily. There are currently 28 million ounces of physical metal backing that entire system. That is a leverage ratio of more than 6 to 1 on the remaining metal, and it gets worse because that 28 million ounces is not sitting idle waiting for buyers. It is already encumbered by existing delivery claims, lease obligations, and ETF holdings that cannot be liquidated without triggering redemption runs. Now let AS cross the ocean to Shanghai, because what S happening on the SHFV is even more catastrophic. China AS domestic silver inventories reported by the Shanghai Futures Exchange collapsed to 691 metric tons as of December 31st, 2025. That is 22 million ounces in total SHFE warehouse stock. But in late October, analysts were tracking SHFE inventories at only 531,201 kilograms, or roughly 17 million ounces, before a small inflow arrived in November. What this tells you is that Chinese vaults are operating at the lowest levels in a decade, while domestic industrial demand from photovoltaic solar production, electronics manufacturing, and EV battery components is consuming over 200 million ounces annually inside China alone. That metal is not being replaced. It is being pulled from strategic reserves that no one is allowed to audit. And the moment China, Australia's domestic supply, cannot meet internal demand, the export licensing system will quietly approve 0 tons for export, regardless of how many companies hold licenses. This is not speculation. This is exactly what China did with rare earth exports in 2025, when approved exporters received licenses but no actual quotas. Here is the hidden liquidity operation that the mainstream financial media will not touch, because it exposes just how broken the pricing mechanism has become. In mid-December 2025, the CME Group, which operates COMEX, raised margin requirements on silver futures contracts by 33%. That means traders must now post significantly more cash up front to hold leveraged silver positions. The official explanation was volatility management, but let me translate that for you. When you dramatically increase margin requirements during a historic rally, you're trying to force leveraged speculators out of the market to reduce the number of contracts that might demand physical delivery. This is not risk management. This is systemic defense. The clearinghouses know they cannot deliver the metal if too many longs stand for delivery, so they engineered a margin spike to shake out weak hands and reduce total open interest before the contract expiration. But it didn't work. After a sharp one-day sell-off on December 30th that saw silver plunge 11% in the steepest single-day drop since September 2020, the price rebounded immediately and is now trading higher than it was before the margin increase. That failed shakeout tells you everything you need to know about the underlying physical tightness. Let ATS talk about the depletion trajectory, because we are not looking at a short-term squeeze that resolves in 6 months. We are looking at structural annihilation of above-ground inventories that cannot be replaced by mine production. Global mined silver production in 2025 reached approximately 837 million ounces, according to the Silver Institute. Industrial demand alone consumed 580 million ounces. Add investment demand, jewelry, and silverware, and total global demand topped 1.24 billion ounces in 2025. That is a supply deficit of over 400 million ounces in a single year. And we have been running cumulative deficits for 5 consecutive years, now totaling more than 820 million ounces. Where did that metal come from? It came from above-ground inventories, from ETF liquidations in 2023 and 2024, and from recycling flows. But here's the critical point. Recycling cannot scale fast enough because 70% of silver is mined as a byproduct of copper, lead, and zinc operations. You cannot just turn on more silver mines. Silver production is tied to base metal economics, and with copper and zinc prices depressed throughout 2024 and early 2025, many of those mines curtailed output or delayed expansion projects. Mexico and Peru, which together supply nearly half of the world's mined silver, reported flat to declining production in 2025. There is no cavalry coming to refill these vaults. Now the institutional panic is starting to surface, and it is coming from the entities you would least expect. Elon Musk, who runs companies that consume millions of ounces of silver annually in Tesla solar panels, battery systems, and electronics, issued a public warning on December 28, 2025, about the consequences of China's export restrictions. Musk's companies are among the largest industrial consumers of silver in North America, and his public alarm signal was not about price. It was about availability. Tesla's solar division alone requires tens of millions of ounces per year for photovoltaic cell production, and photovoltaic demand surged 64% in 2024, making it the single largest source of silver demand globally, surpassing even jewelry for the first time in history. If Tesla cannot source silver, its entire solar rollout stalls. If solar manufacturers across Europe and North America cannot secure supply, their production lines go dark, and the green energy transition that every government on Earth has committed trillions of dollars to, financing collapses because there is no substitute for silver in high-efficiency solar cells. The corporate scramble is happening behind closed doors, but the evidence is leaking into public filings. Major electronics manufacturers in South Korea, Taiwan, and Japan have begun securing multi-year forward purchase agreements at prices well above current spot. And those agreements include physical delivery guarantees that bypass the futures exchanges entirely. In October 2025, India, Nova silver imports collapsed by 42% year over year to just 3,302 metric tons in the first 8 months of the year, creating a domestic supply crisis during the festival season when silver jewelry demand peaks. Indian importers could not get metal even at elevated prices because the global supply chain was already stretched beyond capacity before China activated its export controls. By late 2025, Indian dealers were projecting that silver imports would need to reach 5,500 to 6,000 metric tons in 2026 just to meet domestic demand. But now, with China's export choke point in place, that metal will not arrive. India will be forced to compete with European and American manufacturers for the remaining non-Chinese supply flowing out of Mexico, Peru, and Canada, and that competition will send premiums vertical. Let yes destroy the illusion that COMEX spot prices reflect anything resembling physical reality because the detachment is now absolute. On October 10th, 2025, the London spot silver market experienced a premium of $2.50 per ounce over COMEX futures. That spread is unheard of in normal markets where arbitrage mechanisms keep prices aligned within pennies. But in October, the arbitrage broke because there was no available metal in London to buy and ship to New York to close the gap. Traders who tried to execute that arbitrage found themselves unable to source physical silver in London at any price, which is why the LBMA market froze for 90 minutes that day. Fast forward to today, January the 2nd, 2026, and physical dealers are now quoting premiums of $18 to $22 over spot. If COMEX is showing $72, the real transaction price for 1,000-ounce bars with verified delivery is $90 to $94, and that assumes you can find a seller willing to part with inventory. Smaller retail products like 1-ounce coins and 10-ounce bars are commanding even higher premiums of $25 to $30 over spot because the retail supply chain ran dry weeks ago. The U.S. Mint suspended sales of Silver Eagles twice in 2025 due to blank shortages, and those suspensions are about to become permanent because the Mint cannot source the silver blanks it needs from global refiners who are prioritizing industrial contracts over government coin programs. Now, let me walk you through what happens next in 3 distinct phases because this repricing event will not be linear and it will not be peaceful. Phase 1 is the liquidity death spiral, and it is happening right now. In this phase, COMEX and LBMA continue to function, but physical premiums expand so far beyond paper prices that the futures market becomes irrelevant to actual buyers and sellers. Industrial consumers stop hedging on COMEX because the futures price no longer reflects the cost of securing real metal. Instead, they enter bilateral agreements with mining companies, refiners, and recyclers, cutting out the exchange entirely. This destroys the liquidity and price discovery function of the futures market. And once that happens, the paper price collapses or spikes violently with no relationship to supply and demand fundamentals. We saw early signs of this in December when COMEX silver plunged 11% in a single session, despite no change in physical market tightness. That was pure paper market liquidation driven by margin calls, and it had zero impact on physical availability or premiums. Phase 2 is the repricing shock, and it begins sometime between February and April 2026. In this phase, one or more major industrial consumers publicly announces that it cannot secure sufficient silver supply to meet production targets, and the announcement triggers a recognition event across the entire market that paper contracts are worthless. This could come from a solar manufacturer in Germany, an electronics firm in Japan, or even a defense contractor in the United States that relies on silver for missile guidance systems and advanced radar components. Once that announcement hits, every industrial consumer still relying on futures contracts for hedging will simultaneously try to exit paper and secure physical, creating a run on deliverable metal that COMEX and LBMA cannot possibly satisfy. At that point, exchanges will either suspend trading, impose delivery limits, or force cash settlement at arbitrary prices, and the lawsuits will tie up the system for years. But the industrial consumers will not wait for legal resolution. They will pay whatever price is necessary to secure metal, and that price will not be $72 or even $100. It will be whatever the last remaining holders of physical inventory demand, and those holders know they have the leverage. Phase 3 is the sovereign intervention, and this is the true endgame. By mid-2026, silver will have become a national security issue for the United States, Europe, and Japan, because without it, you cannot build solar panels, 5G infrastructure, electric vehicles, semiconductors, advanced batteries, or military electronics. At that point, governments will intervene, either through export bans on their own domestic production, forced requisitioning of private inventories, or direct bilateral deals with mining companies that bypass open markets entirely. We have already seen China execute this playbook with rare earths in 2024 and 2025, and the United States is now staring at the same dilemma. The The U.S. Geological Survey reported in January 2020 that the United States has virtually no strategic silver reserves and imports more than 70% of its annual industrial silver consumption. If Mexico, which supplies the largest share of U.S. silver imports,